Goldman Sachs just filed to own Bitcoin directly. Not through a fund, not through a derivative, not through a futures contract that expires and rolls over and costs you basis points every quarter. Directly. And what that one regulatory filing actually signals about where this market is heading and how fast is something most people in the space are dramatically underestimating right now. By the end of this video, you will understand exactly what Goldman's move means structurally, what the historical precedent tells us about what comes next, and what the on-chain data is saying about whether Bitcoin has already begun pricing this in or whether the real move is still in front of us. If you're someone who wants to understand what's actually happening beneath the surface of this market, not the Twitter takes, not the price target headlines, but the institutional mechanics and the data, this channel is where that analysis lives. Every video here goes deeper than the noise. Hit subscribe and turn the bell on so you don't miss what comes next. And if this video gives you something you're not finding anywhere else, the like button tells the algorithm that more people need to see this. Now let's get into it. Goldman Sachs, one of the oldest and most powerful financial institutions on the planet, has filed with the SEC to hold Bitcoin exposure directly on its own balance sheet. This is a departure from their previous approach, which involved offering clients access to Bitcoin through exchange-traded products and structured derivatives, instruments that give you price exposure without the institution ever touching the underlying asset. What has changed is the filing now positions Goldman to hold actual Bitcoin, or products that directly represent Bitcoin ownership, rather than instruments that approximate it. The immediate market reaction was what you'd expect: a surge in price, a wave of euphoric headlines, and a chorus of analysts declaring that $120,000 is now inevitable. But here's where things get interesting. Because if you look at what this move actually represents at a structural level, the real implication is not about price targets. It's about something far more fundamental than that. The reason this matters is not because Goldman Sachs buying Bitcoin pushes the price up. It's because Goldman Sachs filing to own Bitcoin directly changes the institutional permission structure for every other major financial institution that has been sitting on the sidelines. Think about how this works in practice. A pension fund, a sovereign wealth fund, a major insurance company. These entities do not make investment decisions the way you and I do. They follow frameworks. They require precedent. They need to be able to point to peer institutions who have made the same decision before them, because the career risk of being first is enormous and the career risk of following is manageable. Goldman going direct is not just Goldman going direct, it is Goldman handing permission to every other institution in the world that has been waiting for exactly this kind of cover. For retail investors, this means price pressure from a demand source that is not price sensitive in the way retail is. Institutions accumulating Bitcoin are not watching the 2-hour chart. For corporate treasuries considering a Bitcoin position, this is the data point their board has been waiting for. And for the broader regulatory environment, this is a signal that the largest and most politically connected financial institution in the United States has decided the asset is legitimate enough to hold directly. That has implications that extend well beyond any near-term price move. Most people watching this story are thinking about it the wrong way. The crowd is looking at Goldman's name and thinking about price. Smart money is looking at Goldman's filing structure and thinking about time. The question isn't whether this is bullish. Of course it's bullish. The question is over what time horizon and who positions correctly before the majority of that move happens. Right now, retail sentiment is elevated but not euphoric. The fear and greed index is in greed territory but hasn't hit extreme greed. That tells you something important. The excitement around this filing is real, but it hasn't yet triggered the kind of reflexive FOMO that historically precedes local tops. The crowd is excited but not yet irrational. The more interesting signal is what large wallets are doing. On-chain data from the past 30 days shows a net reduction in Bitcoin balances on major exchanges, meaning coins are moving off platforms and into cold storage or custodial wallets. That's accumulation behavior, not distribution behavior. And it's happening quietly beneath the surface of the Goldman headlines. The historical parallel that no one is drawing right now, and it's the most important one, is not 2021. It's 2004. In 2004, the first gold ETF launched in the United States. Before that filing, institutional allocation to gold was limited and structurally difficult. The ETF didn't just make gold easier to own, it changed the permission structure for the entire institutional investment world. In the 12 months that followed the launch of GLD, gold appreciated over 20%. But more importantly, over the next 8 years, gold went from roughly $400 per ounce to over $1,800. The ETF launch wasn't the top, it was the infrastructure that made the top possible, years later. The Goldman filing is not the same as a gold ETF, but the structural dynamic is identical, a major institution creating the mechanism that opens the door for everyone else. The bearish parallel, and this one is equally important, is what happened in late 2021. At the end of 2021, institutional interest in Bitcoin was at its highest point in the asset's history. Major corporations had added it to their balance sheets. ETF applications were being processed. The narrative was that the smart money had arrived. Bitcoin peaked at approximately $69,000 in November of that year, and then lost 77% of its value over the following 12 months. What happened was not that institutions left, it was that the macro environment turned hostile. The Federal Reserve began one of the most aggressive rate hiking cycles in 40 years, and risk assets including Bitcoin collapsed under the weight of tightening liquidity. The lesson from 2021 is that institutional adoption is not sufficient on its own. Macro conditions determine whether institutional accumulation turns into price appreciation or institutional accumulation followed by institutional loss. Now this is where the data becomes extremely important. The MVRV ratio, which measures the relationship between Bitcoin's current market value and the aggregate cost basis of all coins in existence, is currently sitting in a range that has historically marked either the beginning of a major appreciation phase or the early innings of a distribution cycle. The distinction between those two outcomes has consistently come down to one factor: whether long-term holders are accumulating or beginning to sell into strength. Right now, long-term holder balances are increasing. Coins that have not moved in over a year are at near record levels as a percentage of the total supply. That means the most informed, least reactive participants in this market are holding, not selling. Historically, when long-term holder accumulation continues while price rises, the move tends to extend. When long-term holders begin distributing into a rally, when they start moving coins that have been dormant for years, that's the signal that the cycle is maturing. Exchange reserves have been declining consistently for the past several months. When coins leave exchanges, they leave the liquid supply available for sale. Supply leaving the market while institutional demand enters from the other side is the textbook setup for a supply shock. This is not speculative, it is arithmetic. If the available sell-side supply is shrinking and a new category of buyers is entering the market, price moves up until equilibrium is found at a higher level. The variable is the speed at which that equilibrium finds itself. The macro context matters enormously here. The Federal Reserve is in a different position than it was in 2022. Rate cuts are no longer a theoretical future event. They have begun, and the market is pricing in additional cuts over the next 12 months. When the cost of capital falls, the opportunity cost of holding a non-yielding asset like Bitcoin falls with it. When the money supply expands, and it always does in a rate-cutting environment, the fixed supply of Bitcoin becomes more attractive by comparison. The dollar has shown signs of softening in recent months. Historically, Bitcoin has had an inverse relationship with dollar strength. When the dollar weakens, Bitcoin, priced in dollars, tends to rise. All three of these macro conditions, rate cuts, money supply expansion, and dollar softening, are converging simultaneously with a structural demand catalyst in the form of institutional filings like Goldman's. The bull case here is straightforward and serious. Post-halving supply dynamics have reduced the rate at which new Bitcoin enters the market by half. That supply reduction is now meeting institutional demand from entities that are not price sensitive and whose mandates require them to stay invested once they've allocated. If exchange outflows continue and institutional inflows from Goldman and similar institutions accelerate, the available float of liquid Bitcoin becomes extremely thin. In that environment, price moves can be sharp and fast. The 2020 to 2021 cycle saw Bitcoin appreciate over 1,500% from its COVID low to its cycle high. The setup going into that move, post-halving supply shock, institutional entry, macro tailwinds, rhymes with what we're seeing now. The bear case is equally serious and should not be dismissed. The first risk is regulatory reversal. Goldman filing is not Goldman being approved. If the regulatory environment shifts, if a new administration, a new SEC chair, or a major market event triggers a crackdown, institutional players will exit, and they will exit fast. The second risk is macro deterioration. If inflation reaccelerates and the Federal Reserve is forced to abandon rate cuts or return to hikes, the liquidity environment that supports Bitcoin's thesis gets dismantled. Bitcoin sold off 60% in the first half of 2022 when rates went up. It can happen again. The third risk is correlation. In a genuine risk-off environment, a credit event, a geopolitical shock, a banking crisis, Bitcoin does not behave like digital gold. It behaves like a high beta risk asset. It falls with equities, sometimes faster. In the next 30 to 60 days, there are three signals that will likely clarify which scenario is actually playing out. First, Goldman's actual position disclosures. When they file 13F reports and SEC holdings disclosures, the size of their direct Bitcoin position will tell you whether this is a token allocation for client service reasons or a serious institutional commitment. Second, watch the exchange reserve data. If coins continue to leave exchanges at the current pace, the supply constraint thesis strengthens. If exchange reserves start rising, that suggests either institutional sellers entering the market or retail taking profit into strength. And watch the Federal Reserve's next meeting and the language around their rate path. If they signal a pause or a reversal, the macro tailwind flips to a headwind, and the Goldman catalyst alone is unlikely to sustain a move above current levels. What Goldman Sachs filing to own Bitcoin directly ultimately tells us is that the question of whether Bitcoin is a legitimate asset class has been answered, not by Bitcoin advocates, not by retail investors, not by the internet, but by the institution that arguably has more influence over the global financial system than any other. That is not a small thing. That is a decade-long argument being settled in a regulatory filing. The question that remains open, the one that determines whether we look back at this moment as the beginning of Bitcoin's greatest bull cycle or as a premature celebration, is whether the macro environment cooperates with the institutional thesis, or whether it conspires against it the way it did in 2022. Bitcoin has survived bear markets, regulatory crackdowns, exchange collapses, and media obituaries. What it has never had is a simultaneous convergence of post-halving supply shock, spot ETF infrastructure, direct institutional ownership, and a global rate-cutting cycle. That combination is either unprecedented and historic, or it's the setup for the most well-telegraphed top in the asset's history. I want to know what you think. Does Goldman's move represent the institutional inflection point that takes Bitcoin to a new all-time high this cycle? Or is history setting up to repeat in a way that catches most investors completely off guard? Tell me your read in the comments. How are you doing?